Doop, 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 doop. Hello, friends. Good afternoon slash morning. Hello, hello. Good to see everybody. Chat is lively. What's up, everybody? Hello, hello. Welcome, friends, to Alpha Beta Soup. I'm TXMC. It's your boy. January 12th, 2024. It's 11 a.m. Beautiful Austin, Texas, USA. Great to see everyone in the chat today. Smash that like button if you haven't already. Man, before I even got here today, we have a new member of the stream, new supporter of the channel, Haveri, I believe, became a channel member, and we also had David gifted another channel membership, truly coming in as a major supporter ever since we started doing these. Thank you, David. Appreciate it. Welcome, everybody. Man, what a week. It's ETF week. We're now on day 2 of Bitcoin spot ETFs being approved. And, for those of you who were paying attention on Twitter, the day before we actually got the ETFs was an absolute shit show. Somebody hacked the SEC's account and posted a fake tweet saying that all of the ETFs had been approved. And it was chaos. It was absolute chaos. Bitcoin spiked up to 49,000 and then immediately dumped off. We flushed a ton of leverage. And then the actual launch of the ETFs was kind of ho-hum, it wasn't bad, but it wasn't really great either. And then today we're selling off. And I've been sitting here for the last couple hours trying to think, how the fuck do we even... How do we even go through what's been happening the last couple of days? How do I even begin to sum all this up? I don't even know if we can. I don't know if it's even in our interest to try to do a full recap of all of the crazy shit that happened over the last few days. I guess we could look at my feed and see a couple of the things. I'm gonna zoom. I'm gonna go back here. Where's my feed? Here we go. Before we even look at the price chart. So I didn't tweet it. They deleted the tweet. You can see here it says post unavailable. But what happened was the SEC account tweeted out that all of the spot Bitcoin ETFs had been approved. And when that happened, for a few minutes there, the market believed it. And they actually thought that it had really happened. And this was BTC, right here in that moment. And just a few minutes later, Gary Gensler came out and was like, someone compromised that account. That's totally not what we meant to do. And so naturally it was mayhem. The tweet stayed up for a while and everyone was wondering what was going on. My first thought was, what if this was the exact same person who did the Cointelegraph stunt in October when they... I forget what the actual announcement was. I can't remember if it was an approval of the ETFs. There was some kind of fake tweet that came out of the Cointelegraph account in October, and that's what really kind of kicked off the pump, right? That was right when the pseudo alt season that we've seen kind of started, and when the move higher on Bitcoin really started. That was in October. And so I just wondered, two and a half months later, if it was the same person. That would be just legendary, whoever that person is. But anyways, so turns out the SEC did approve all the Bitcoin ETFs. It was just a day later, so they had all the wind taken out of their sails. Everyone knew it was coming. I don't think anyone honestly believed that they just were not going to approve all the ETFs after getting this close and after negotiating back and forth and having all of these filers continually update their filings to be able to be in compliance. This was a lot different from the prior fake outs, right? Where the SEC didn't even want to talk to anybody or work with anyone. A lot more effort had been put in here. So I think it was just unrealistic, especially when industry experts, people like who work for Bloomberg, who do this for a living, are saying they're going to get approved. So it was almost unbelievable that they wouldn't. And a lot of leverage and just energy and pent up, energy, I guess, for lack of a better word, had been building up in the market. Now, I mean, like that's like we've been climbing for weeks, and most of it's been on anticipation of an ETF coming, right? That's what most of this has been, which is why I've pushed back frequently on the idea that none of this is priced in. Now, you can't price in people putting Bitcoin in their retirement accounts. I get that. And, the long-term pricing in of a thing, it hasn't happened yet. I get that. But the anticipation of the event, the people who will move price around on the day the event happens and before it, all those people were already positioned. They've been getting ready for this for weeks. And that's why oftentimes when the news comes out, the price action doesn't do what the lowest information market participant expects it to do, because that person doesn't seem to grasp that the price has been doing what you think it should be doing today for all the weeks leading up to today, because it knew this was coming, because we've all known it was coming, because it's the only thing anyone can fucking talk about. It's on the news every day. Like, everybody knows it's coming, right? So the idea that none of that was baked into the price was ludicrous to me. And when we got the fake approval, the same way that we got a bunch of leverage flushed a week ago when there was a fake news story about them all being denied, both of those were clear evidence that there was a bunch of pent-up energy in the market specifically around this event. Well, now a lot of that got sucked out the day before by the fake tweet. And so I think some of that volatility we would have seen yesterday if we didn't get that. Who knows what would have happened? I don't know if price would have done exactly the same thing, shoot up to 49K and then come right back down. Who knows? But it's clear that some of that got siphoned away. And so yesterday wasn't as volatile in either direction that anyone really was expecting. And no one really got what they wanted, right? A lot of the super bulls were expecting a God candle, and they got nothing of the sort. There were people that expected it to be a major sell the news event and that price would just dump like hell. That didn't really happen either. We are dumping now, a day later. But I think that the whole idea of what's priced in, what isn't priced in, is kind of a silly conversation. Information makes its way into price as soon as the information is known. And as more people know about it, the price continues to kind of find an equilibrium. And it's not unless the market gets surprised by new information does it move quickly, right, on that surprise. So inflows long term, we don't know what that's going to do. On the long arc of history for Bitcoin, the approval of spot BTC ETFs is a major milestone. It's a huge success that this amorphous joke internet money that was worth literally zero 15 years ago has turned into an 800-something billion dollar market cap behemoth that has now got 10 different spot ETFs by the likes of BlackRock, Vanguard, etc. I'm sorry, BlackRock, VanEck, Fidelity, etc. Not Vanguard. It is a huge step. And so, I don't want to take anything away from that. But at the same time, it's also still a very misunderstood asset. It's extremely volatile. It has a bad reputation, particularly after the last couple of years, and because of the constant FUD fest that politicians are always working against it, like Elizabeth Warren and such. And people who are outside of crypto, that's like the only information they get, right? Unless they have someone in their life who gives them some better info that they trust. And so we still have a lot of work to do, like just as early adopters of this tech. We have a lot of patience that we have to continue to pull from. And this is just going to be an ongoing process of educating people. And it's not realistic to think that in the first couple of months that there's just going to be many trillions of dollars of inflows of pent up retirement demand into this thing. I just don't think that's realistic. So we'll see what happens. Right now it's getting sold today And if we looked at all the ETFs, this is kind of what they look like. I have been watching this view. This isn't all of them, but this is like the 5 of the biggest ones, plus Bitcoin in the top left. And I've been watching these the last couple of days. And this is just, this is not the debut I think a lot of people were expecting. It's only the second day, so this is not conclusive. But people had unrealistic expectations of the first 24 hours, 48 hours, first handful of sessions, I think. I have been told that next week is when the real flows arrive. Just like everyone was supposed to be bullish about the announcement. Well, the announcement wasn't quite as bullish as people thought. Well, just wait for day one flows. Well, we got the day one flows. We'll talk a little more about that. Wasn't quite as impressive as people thought. So now people are saying, well, just wait till next week. The big players, the big swinging dicks, they can't trade it on the first day. So just wait till next week. That's when we'll see the real flows. Oh, okay. Well, we'll check next week. But if you were wrong about the announcement and you were wrong about day one, you're losing credibility with me about waiting for next week. We'll see. The day one inflows, I've been seeing a lot of information on Twitter. And let me pull this over here. So this is Eric Balchunas, who's been one of the more reputable people talking about the ETFs. He works for Bloomberg. And I saw one of his tweets here, and this is not a knock on Eric. I think we're all just trying to figure out what's going on. He listed the day one flows for the different ETFs, and some of these match up with some of the volume numbers and things that I've seen. This IBIT is the BlackRock ETF. He has $111 of flows. That makes sense because if you go look at the ETF website, it shows their initial BTC holdings from yesterday, which is like 10.5 million. And then on top of that, they show another chunk of cash that's sitting in their holdings that I guess is going to be waiting to be turned into BTC. That one matches up. But the one that confused me is this top one, BitB. This is the Bitwise ETF. And he lists $237 million of inflows. And what confused me about this, and I replied and asked him, how did Bitwise have $200 million of inflows when they had 4.5 million volume of shares at $26 a share? That's $120 or so million of volume. How could they have $120 million of volume but 200 million of inflows? The math doesn't add up. And the reason I asked him that is because I have an indicator that I built called dollar volume, and it literally is that. And yesterday, where is it? That's IBIT. Sorry, BitB. Yesterday it shows, you can watch this number right here, $122.3 million yesterday in volume. And so I was like, how is it possible that they have 200, whatever you said, $200 million of inflows with not that much volume? And a couple of people have written back and said that's their seeding amount. So every ETF has an initial seeded amount. Like the BlackRock ETF had $10 million in it to start with. The Bitwise one had $200 million initially pledged. I went and looked that up, and that's true. Bitwise plans to seed with $200 million from a firm, I think it's Pantera Capital is the firm that promised this. And that was part of their filings. But what confused me is that Eric is considering that day one inflows, but that was literally in the filing. So that's what they started with. So I don't think that they had $200 million of inflows. I think it's more likely they had 30-something million dollars of inflows, right? The delta. So we'll see. It doesn't really matter. It's the first day. But people are really excited. The volume was really high. So the traded volume across the whole edifice, I think, was about 4 billion or something like that. And that's really good. That's actually great volume for all 10 or 12 combined. But it's important to note that volume is not assets under management. Volume is not adoption and holdings. It's just traded back and forth execution volume, right? What matters is how many people are holding at the end of the day. And, if you just look at these hourly charts, it can't be that many people because they've been sold into so heavily. This is like net selling, right? So I don't really know what the net is of all of the different instruments. There's a lot of volume that's coming out of GBTC. They existed before, right? That was the Grayscale Trust. They got converted into an ETF along with all the others being approved, but they have the highest fees. So a lot of these other guys had a bidding war, so to speak, on lowering their fees before the ETFs launched. yesterday. And many of them had lowered their fees from their initial pledge down to like 0.2%, 0.1%. A couple of them have decided to waive fees for a certain period of time. And then it makes you wonder how they're making money. But that aside, the Grayscale ETF still has 1.5% management fees, which is by far the highest of all of the 11 that got approved. So a lot of rotation is happening and is likely to continue happening out of this instrument and into other instruments. People wanting to hold the exact same thing but pay less every year for it will just logically sell GBTC and buy like the Fidelity one or something like that. So we're likely to see some of that over the next first few days, first few weeks of all these things trading. So maybe that nets out to some gains on some of these and some losses on GBTC. We'll see how that goes. But I think it's an exciting few days. It's an exciting milestone in the life of this asset and in the legitimacy of this asset class. I don't think that it is a new paradigm for the market. I don't think that it's going to ensure a permanent bid for Bitcoin the way people see a permanent kind of passive bid for things like Apple and Microsoft. We may get to that point. I think in the future, that's more likely. But we're nowhere near a place where the average investor wants to do that. And where we have time needs to go by before that's true. So that's where I stand on these things. I'm not a fudster about it, but I'm a pragmatist. And, it's great. It's cool. But we have a bad history of instruments launching and it marking tops. I posted this morning. If you think back to major financial products being launched on Bitcoin, they've all been launched at major reversal points in the market, right? CME futures launched just after the peak in 2017. The Coinbase direct listing. Now, Coinbase was already around, but their public debut to the market and to the normies was at the literal top in April of 2021. It was to the day, the top. The ProShares Bitcoin Futures ETF launched in late October of 2021, in between the two peaks that marked the actual all-time high. And then somewhere in June of 2022, I think, I don't have it on here, was the BITI short ETF. And it got launched like at the bottom of a major sell-off after the 3AC crash or somewhere around. And it was somewhere around in this period of time right here. They launched a short ETF. And then over here, we ramp all the way up. We're all the way up here in the 45, 48, 49 area. This is where we are. And they launch an ETF, 11 ETFs. So is it possible that we just marked another top with another financial product on Bitcoin? Maybe. It would be hilarious. You have to admit, it would be funny. No one wants the price to go down. And maybe you do if you want to buy some more. I mean, it's not exciting to see things be worth less, but it would be hilarious if that happened again. Here we are. We just swept this low. We'll see if market structure continues. We'll see if it sets a lower high and then continues down. If so, that's an ugly structure, right? This is a tough place on Bitcoin right here. This is a really tricky spot. Here's the retracements. Yesterday's move perfectly swept the 618 retracement. It also perfectly swept the 2022 high, which is right here. Oh my goodness. Would be helpful if I could spell center. Yeah, there's the 2022 high, which was at the 618. We swept it yesterday. Oh, the lines aren't showing up. Why isn't it showing up? Sorry, guys. Visibility. Yeah, there we go. Let's go down to the 4 hour. Look at that. We swept the 618. We swept the 2022 high. We wicked just over 49,000 on Coinbase. And now we've come down and we've broken this local low from January 8th. That's not pretty. You know, it's still the early portion of this structure. We'll give it time. You know, we're not going to make a big proclamation, but you know, I know that my buddy Blockchain Backer, he thinks this might be the top or very close to it. You know, no one knows the actual Pico Wick top, but I know that he de-risked. I have sold out of the BTC that was in my trading account. I still have a spot bag, like a long-term spot bag that I don't consider like a traded bag. But my traded BTC, I sold it. I still have some ETH and some other things in the trading account. I'll sell those higher up because I think we might see a rotation if that's true. And, you know, we're starting to see the dynamics form for that. ETH BTC is up 5.5% today on a day when Bitcoin is down 6.5%. So Ethereum is now down 1.5%. Ethereum was up just a little while ago. It rolled over a bit with Bitcoin, but it was actually green like 2 or 3% while Bitcoin was down 4 or 5%. That was a really interesting kind of moment there about an hour and a half ago. I have long thought it was realistic that BTC get up to 50K or maybe 53,000. 53 is the 702. And depending on which way you do TA and like which kind of levels you try to mark out, I thought it could go as high as 58. But I've not believed that we were on the way to another all-time high until we resolve much of the unsettled question marks about the economy in the late cycle dynamics that I believe we are clearly in. We've talked about that quite a bit together here on this channel over the last few weeks and months. That I do believe we're in a late cycle dynamic, and I think that this is the long-awaited last gasp retracement of a broader cycle conclusion that forms a fractal that we aren't familiar with on Bitcoin, and that potentially marks the end of the equity cycle as well, somewhere, or at least near to it. We might not quite be there with equities. They're in a little bit of a different place, but they're not correlated one-to-one. They can top at different times. And so I think we are closer to the high on Bitcoin than we have been at any point. I don't think we're going to go to the all-time high. And I've long suspected the range was somewhere in here, right? We'll go back to the other chart. It's here. I was talking to BCB about it this morning because, you know, I saw his tweet yesterday. He made a tweet yesterday saying he had sold all of his Bitcoin except for the small amount he's had from a long time ago. That's been his plan, and he executed on it publicly like a fucking boss. You know, kudos to him. And so I was talking to him like, do you really think it was the top yesterday? And, you know, his feeling on it is, from my perspective, is like, yeah, we look at the sentiment, look at how excited everyone has been. They're getting max bullish into retracement levels. We're still nowhere near the all-time high. I mean, how far away are we? 40% away, 59% away from the all-time high. Max sentiment, right? We have the ETFs that have been bought into for weeks leading up into it, and then we just happen to sweep the 618 and the 2022 high on the day that the ETFs launch. Their flows are unimpressive. Everyone's max bullish, looking for God candles, and it reverses on high volume. And then I saw something just to top it off. I think I saw him tweet something else just before I started my stream. I was just kind of looking through my feed and seeing what people were talking about. I saw him tweet this: reversal volume on BITI. That's the short ETF we talked about that launched in like June or something of 2022. Then look at the volume over here. You can kind of barely see it. Really high red candle volume, and then huge green candle volume on the short ETF. Like the highest ever volume on the short ETF. That's funny. I don't know. I just think this perfectly sets up to be at a top for a while on BTC here, just because of the expectations of it not being that, and the fact that if you suggest that to people, they think you're a fucking moron, right? Are you serious? We literally just had 11 spot ETFs be approved on the world's first absolutely finite asset. Are you serious? You actually think this is the top? You have no idea what you're talking about. That's the sentiment that people have when you say those kind of things. And as we have been climbing, and I haven't changed any of the tone of the things that I say, the feedback loop from the mob and from the public of being cautious and being, tilting bearish, while still being long, the pushback has been unreal. And it's kind of disconnected from where we are in price, because typically, like if you just think back to prior bull markets, sentiment is not this bullish, this far away from the highs. This isn't a normal dynamic. That's part of what feeds the feeling that it's late cycle from a sentiment perspective as well, is everyone is incredibly bullish and we're still below all-time highs, like well below. There's still a lot of latent risk-taking behavior in the market that was not extinguished by the bear market of last year really at all. It took people a couple of months to get excited earlier on in 2023 when we first shot up, and then we just kind of hung around here for like 6 months. People didn't really know what to think. But as soon as we started breaking up, they were like, oh, it's back on, baby. The ETFs are coming. We're going to the all-time highs. The cycle has restarted. We're all riding to Valhalla together because we have now figured out the pattern and we're all on the right side for the first time. Let's fucking go. I'm like, that's how everybody feels. The chances that is correct are very low because everyone's on one side of the boat. The draw on liquidity for the market is in the other direction, right? The balance, the way to find equilibrium in a market when everyone is on one side of the boat is to tip the boat over. So I think this is a really shitty spot. I've thought BTC could go higher. Maybe it does. But the behavior of the market is kind of suggesting that it thinks maybe BTC is topped. The way that we've seen Ethereum outperform the last 2 days has been really interesting. Where did I put that chart? Put it right here. Here's Bitcoin. Here's Ethereum. Look how much better it has performed just in the last couple of days since the ETF launched. People told me when I said that, I pointed this out, I tweeted this yesterday. I was like, Ethereum's more excited for the Bitcoin launch than Bitcoin. Bitcoin ETF launch than Bitcoin is. And people told me, well, that's just because now the market has pivoted to anticipating the ETH ETF. So you guys agree that the market prices these things in beforehand? Like the disconnect in people's minds is mind-blowing. Everyone told me that these things aren't priced in, and then I point out Ethereum is more excited than Bitcoin, and they say, oh, it's because it's pricing in the ETF. What? That's the opposite of what you all told me a few days ago. Oh, this has just been a funny like year and a half. The continual existence of people trying to front run the 4-year cycle is part of the reason that I feel like we didn't really reset the market in 2022. We had some cataclysmic events. Some people lost money from FTX because they're crooks. And we had some funds blow up and some, leverage in crypto get extinguished. But we didn't really people didn't completely lose hope in the market, right? We had people YOLOing on ordinals like at the beginning of the year in 2023, last year, right? Like a year ago. All that stuff exploded kind of like out of nowhere, just a month after FTX had gone under. And, it's just, we didn't reset the market. I'm going to take a sip of my water here. My mouth's really dry. I'll give you some full disclosure here. I've been trying to get ready for this stream today, and I've got a couple other things we can talk about, but I've just been struggling to get my thoughts together because we got some really horrible news about a friend of ours who had a very close family member pass away suddenly overnight. No one expected it to happen. They weren't of ill health. They were quite young, and they they died suddenly overnight, and it just kind of interrupted like everything we were doing this morning. You know, I've been talking to my wife about it. People have been calling on the phone and everything. So my thoughts have been a little split. So sorry if it, you know, if I keep stopping what I'm saying, or if I maybe don't feel like I have a clear direction about what I'm talking about today. I keep, you know, it's kind of hard to stay focused on what's going on in the markets. But you know, it's yeah, I'm gonna take a sip of my water here. Let me look back in the chat, and maybe that'll help kind of reset things a little bit, and then we can keep going. Let's see what's been going on in the chat here while I've been ranting. See if I catch up on anybody. Mentioned David gifting that membership. Thanks so much, brother. Brandon Hammond gifted a membership to the channel. Thank you, bro. Thanks so much. Matt Hebert, welcome. Brandon hooked you up. Code 9 gifted a membership. Your boss, Code. Thank you. Paul, welcome. Welcome. Mr. Nobody joined the channel. Thank you, my dude. Good to see you. I see you on Twitter all the time. JB Estrada says, with all these companies having a fiduciary duty to their clients, how can they create an ETF if we don't know who's controlling BTC's biggest wallet? Let me think. If you mention BTC's biggest wallet, well, I think we know what a couple of the biggest wallets are, right? They're related to exchanges, aren't they? Bitcoin addresses. It's Binance Wallet, Bitfinex. Those are the two biggest ones, right? A couple of these other ones we don't know. People think this is MicroStrategy, but I don't know if they have it all in one UTXO. It might just be an institution we don't know about. And as far as the transparency of the institutions doing these ETFs, you know, and maybe this isn't what you mean, JB, but I have been asked quite a bit, and I've seen people kind of questioning on Twitter, how do we know that these people actually have the BTC they claim? They just telling us that they do, and we don't have the addresses of like VanEck and BlackRock, etc. I do think those things will eventually surface, and that they will be known. It's part of the industry kind of joining with Bitcoin and learning some best practices here. I think that eventually we will at some point have the addresses, or have some kind of heuristic that Glassnode can track, that they know the addresses. Somebody somewhere will have it, and we'll be able to track these things. What I don't think, and I don't think that necessarily you meant this, JB, but I'm just kind of ad-libbing. I don't think it's likely that these institutions like BlackRock and Fidelity would claim to have Bitcoin that they don't have. Their whole reason for being is to manage these assets in an above board way so that they can collect billions and trillions in fees, right? So they are highly incentivized to be within the regulatory framework because they push for a lot of this stuff, because the rules benefit them. They have the most money. They're closest to the printer. They can influence policy and regulation the most. They're the most benefited by following the rules. I don't think that it is likely that they are going to produce a bunch of fake paper Bitcoin beyond what they claim to have and not maintain the balance to NAV that they're supposed to have in their ETFs. So I don't think that's likely. And I know people are scarred because of all of the counterparty problems we've had in crypto native institutions like FTX, like others. And that is completely reasonable and it makes sense. I just think there is a fundamental difference between a Fidelity and a BlackRock versus an FTX or a Mt. Gox or a whatever, you know, firm that's like in the Wild West. So that's just my perspective on that, because I've seen a lot of Bitcoiners like, how do we actually know they have this stuff? Well, I guess right now we're trusting that they do, and with the logical assumption that they have every incentive not to bullshit. Why would they? Right? They could make money without bullshitting. They're going to make a lot. Whereas if they're found to be faking all of this, they could lose their ability to siphon fees off of all of us, and they don't want that. So that's my perspective on it, and I think over time we'll get these addresses. You guys saying sorry for the loss. Thank you. I appreciate that. You know, it's not my loss. It's a dear friend of ours, but it was just distracting. You know, real world gets in the way of talking about the market sometimes. And I was literally sitting here at my desk trying to think like, okay, we got the ETF stuff. We had CPI and PPI come out this week. You know, like there's all these things going on all at once. What do I talk about? And then that happened. And it was like, whoa, wasn't expecting that. Didn't know they were going to die. And so, you know, just kind of scrambled my brain a little bit. Let's see. Katu says, BCB and you are boss. As all ETFs are considered cash trading, they'll wash out the on-chain analysis possibilities that we traded off-chain or in legacy word OTC. Yeah, I think what's going to happen with the ETFs is we're going to end up getting bull and bear ETFs, inversed ETFs, leveraged ETFs, all kinds of stuff. And all of those things will then, it's just going to be more pressures that knock around the core price of the asset during market hours, you know, because of the arbitrage between those different assets that the market makers do to make sure everything stays, you know, in sync with each other, the same way that all the exchange prices stay within a relative spread to each other. That's what's going to happen with all these other instruments, and they'll just work to broadly, you know, interrupt the previous dynamics of the market. I think that TradFi is going to have a larger and larger role in what happens with BTC's price each day, at least during market hours. We'll see. I had some other tabs open here. I'm going to look through them and because I had some other ideas and I'm just kind of blanking right now. So I'm going to look through and see what happened this week and maybe it'll come to me. Yeah. So this is the economic calendar. Sometimes you guys ask me a good website. Go to forexfactory.com, Forex factory.com. They have this dope calendar right here, and you can filter it to different countries. I have it filtered it just to the US, prioritize like the severity of the economic events, the type of the events, and they have this really sweet calendar here. This is what I use to look at economic events each week, and they update in real time. So you can just kind of like leave it open all day and come check on it. Really useful website. We got CPI. It came in pretty much in line. Year over year, CPI accelerated slightly, but it's still low. It's still at 3.4%. And I was looking at rates of change on CPI, and they're really slowing down. On a 3-month annualized rate, CPI is negative because the last couple of prints have been negative. And even though on a year over year basis, it's still 3-something, the negative prints have pulled the 3-month annualized rate down. So we're seeing a real slowdown in inflation on the headline figure, the rate of change of the headline figure. But I also saw a really interesting chart, this one. And this is the percentage of components inside the CPI that are rising 0.2% month over month or more. And so as this figure, the red line is higher, there are more things inside the CPI basket that are rising at 0.2%. When it's falling, there's less, right? Kind of the same way that a PMI is a bunch of people answering yes versus answering no. And so as this, you can see the red line here is starting to accelerate. See it spiking up here a little bit. The black is just regular CPI year over year. And so you can see it's just kind of flat here at 3.4%. But we had a spike up, and this is a noisy series, so take it for what it's worth. It's a pretty choppy series, the red line, but it's showing a higher percentage of components inside the CPI that feed into the headline figure. And a higher number of those little components are rising at 0.2% year over year. We're also seeing stubborn wage growth. Like if we look at the Atlanta Fed wage tracker, that thing I think has been stabilizing. Yep. Look at that. Wage growth stabilized at 5.2% for the last 4 months. So that's when I think about what we've been doing with inflation this cycle, you know, that's been the Fed's main target. And while the headline figure has been coming down, and there is an anticipation that means that the Fed will declare victory soon, maybe they will, there's still elements of the economy that are growing at a rate of change basis that is too high. And so the core basket, which is a bunch of slower pieces like rent, rent of shelter, things that have a bunch of assumptions built into them, and they're very slow lagging calculations. Many of those are still moving at 3 to 4% year over year. But wages are still growing at 5%. PCE is still growing at a fairly high rate. I think it's still in the threes, 4.5%, 5% for PCE. That's personal consumption, people just going out and buying stuff. That's still growing at 4.5%, 5%. And this is likely to continue staying at 4 or 5%, while wage growth is at 4 to 5% and labor remains really tight, right? I mean, if we looked at the unemployment rate came in, and I think it stayed exactly where it was. Yeah, it actually went down in November, but it stayed at 3.7 in December. So the unemployment rate isn't rising. If we look at initial claims, ICSA, if we look at initial claims, they've actually been going down, right? They're not turning up higher in a sign of imminent labor softness. Even though we've been looking at rates of change of job growth slowing down and other elements of labor slowing down, and those things are all true, the headline figures, which are initial claims and the unemployment rate, those things are not moving the way that you would expect them to. I don't have all of the reasons for why that is, but for whatever reason, labor softness on the leading components of labor still hasn't fed through to the headline figure, right? To the total unemployment figure for the nation. Meanwhile, wages are still growing at more than double the inflation target. They're almost at triple the inflation target. Double. Sorry. But I guess 6% would be triple. But the Fed will have difficulty, I think, leaning too hard into any kind of victory declarations. Like if we look at, where's FedWatch? I think FedWatch, the market expects the Fed to start cutting in like March. Let me go look at probabilities. Yeah. So the market is expecting, there's a 74% chance. Let me make this table bigger for you guys. 74% chance that the Fed cuts 25 basis points in March. But the thing is that Loretta Mester, who's one of the Fed governors, just yesterday or the day before, said that a cut in March would be pretty surprising, and that she's not anticipating that happening. The market then thinks that they're just going to keep cutting every meeting after that. Every single meeting until November is better than a coin flip to have a rate cut of 25 basis points. And they're expecting that by the time we get to Thanksgiving, that we will have already taken 150 basis points, 1.5%, off of Fed funds. But I just showed you wages are growing at 4.5%, 5%. We have record low unemployment. We have 8% fucking deficits with full unemployment. So the Fed cutting a whole lot in a year like this does not seem likely to me. And I think there is a sharp repricing that will have to occur at some point. And I don't know when that is, and I don't know what the catalyst for that is. It's, something in the market or the economy has to snap investors out of this kind of lucid dream Goldilocks that they're in. The last couple of weeks, last week we talked a lot about China. We talked about the potential for a secular regime shift in interest rates into a period of higher volatility and higher baseline interest rates, right? We talked about the role of China in the last 40 years in allowing for a low inflation environment with subdued wage growth, and how they're probably not in a position to continue playing that role the same way moving forward. A lot of things are changing. COVID really accelerated some changes that were already in the pipe that really began. You could see some of those with the Trump administration and the rise of populism and the more obvious kind of adversarial posture towards China, less willing to accommodate them, right? And now we're reshoring much of our supply chains. Countries around the world are realizing, holy shit, our supply chains are way too long and way too fragile. And so as interest rates rise, supply chains will shorten, and those things will increase costs for a period of time. And American labor is already pretty expensive. We see wages are growing at the highest rate they've grown in 40 years, and now we're bringing back a lot of manufacturing over here that will raise costs. And so as we've been thinking about these things, and thinking about this secular regime shift, I found it really interesting over the weekend that legendary investor Howard Marks said the same thing that I just said. So our last stream was on January 5th, and on January 9th, Howard Marks had an op-ed in the Financial Times saying, "Say farewell to the corrupting era of easy money." Now, he kind of goes on and on and on. And the summary of what he thinks is, TXMC is right. He literally says that here in his op-ed. No, he says, "So are we likely to see the return of easy money conditions? I believe the consensus is as follows." This is the consensus. U.S. inflation's moving in the right direction and will soon reach the Fed's target of 2%. As a consequence, additional rate increases won't be necessary. As a further consequence, we're going to have a soft landing marked by a minor recession or no recession at all, and the Fed is going to take rates right back down. To me, this smacks of Goldilocks thinking. The economy won't be hot enough to raise inflation or cold enough to bring on a slowdown. Goldilocks thinking has historically tended to create high expectations among investors and thus room for potential disappointment. Of course, that doesn't mean it's necessarily wrong this time. I believe we're not going back to ultra-low rates for many reasons. The Fed may want to avoid remaining in a perpetually stimulative posture given fears about kindling another bout of high inflation. Additionally, one of the Fed's most important jobs is to stimulate the economy if it falls into a recession, largely by cutting rates, and it can't do that effectively if rates are already near zero. On top of this, we appear to be seeing a decline in globalization and an increase in the bargaining power of labor, suggesting that inflation may be higher in the near future than it was before 2021. So I'll stick with my guess that rates will be around 2 to 4%, not 0 to 2% over the next few years. He literally said what we talked about last week and in all of the times leading up to this as we've discussed the potential for higher baseline rates over the next few years. Higher than they were before, right? Doesn't mean that they go up forever. But what it does mean, let me find my tweet. Where did I tweet it? This. I tweeted this, which is what we talked about, right? What it does mean is the dynamic of the last 40 years was this on interest rates. Well, we hit zero. And the likelihood that we're going to have negative interest rates for the global reserve issuer is cataclysmically low. There's almost no chance. So we have, for all intents and purposes, hit a wall on interest rates. And during this period of time, we embedded a lot of very unhealthy risk-taking behavior and moral hazard embedded into the system during this period of time. And now we have raised rates, we have reawakened inflation. Many of the dynamics that allowed for this are now fundamentally shifting. So if the future looks like this or looks like this, which are far more likely, right? Let me pull up where's my little drawing tool? Here it is. This is what we just came out of. This is what we're more likely to have. And either of those is a massive difference from what we just came out of. And as a result, they likely mean higher baseline interest rates, not going back to what they were before. And we are still dealing with that reckoning. We're going to be dealing with it into this year, I think. I had something else here. Where was it? I might get into this with you guys before the stream's out, but we might save it for the future. This is a paper that I just read, and it came out at the end of December, and it's from the NBER. So those of you who are fans of Alpha Beta Soup, who watched my Recession Roundup series in June and July of last year, you know who the NBER is, the National Bureau of Economic Research. They are the group who is officially tasked with dating recessions in the U.S. They're the ones who say that's the peak of the business cycle, that's the trough of the business cycle. They've been doing it for decades. This group released a research paper in December about the risks of interest rates and the refinancing channel and how much stress exists in the banking sector, particularly because of commercial real estate, and how refinancing is not going to go smoothly. It's what we've been talking about on this channel a long time now. And I'm seeing more and more evidence in support of what I feel like I sniffed out before a lot of people did. I'm not trying to toot my own horn. I certainly am not an influential person in markets or in FinTwit. I'm just a guy. But no one was talking about this when I discovered that this was likely a problem. And now more and more people are talking about it. This is the same thing that Lacey Hunt agreed with me on last week. Do you remember last week when we were on here and I played a clip for you guys when I got to talk to Dr. Lacey Hunt? And I asked him about the credit risks that I see coming into 2024 and 25, and he agreed with me. It's the same topic, right? It's the same thing. And now the group that dates recessions is telling you that there is major systemic stress building in regional banks particularly, but the U.S. banking system as a whole. So I want to read a couple of these little excerpts. I've underlined different pieces in here. We're not going to read this whole fucking thing. I'm just going to point out a few of the key data points. Okay. Let's see. Commercial real estate loans account for a substantial portion of bank assets. They're about a quarter of assets for an average bank, and they're about $2.7 trillion of all bank assets. As of 2023, there's several reasons why CRE is commercial real estate, office buildings, right? Industrial and commercial office buildings. There are several reasons why CRE has been considered a potential source of stress. This includes the adverse impact of higher interest rates on the value of assets and their cost of funding, the risk of recession, and the lower demand for office due to hybrid working patterns, right? All those things have changed. That's why I've said for a while now that even if the Fed cuts rates to zero, they're not going to put bodies back in offices because hybrid work is here now. The pandemic opened that up and it's never coming back, no matter what. It isn't coming back the way it was before. So there will fundamentally be less demand for office space, kind of no matter what. That's been my position. About 14% of all loans and 44% of office loans appear to be in negative equity, where their current property values are less than their outstanding loan balances. So 44% of office loans are in negative equity. 1/3 of all loans, all real estate, 1/3 of all loans and the majority of office loans may encounter substantial cash flow problems and refinancing challenges, reflecting in part more than the doubling of the cost of debt following monetary tightening. That's what we've been talking about. That's literally the chart. Where is it? Where's my chart? You know what I'm going to bring up? This one. This chart. The debt exists down here. We're now up here. The market thinks we're going to get this. We're probably going to get something like this. Debt costs need to come down. Debt needs to be down, like the cost needs to be down here, or else it is a significant increase in the cost of financing. If interest rates remain elevated and property values do not recover, default rates could potentially reach levels comparable to or even surpassing those seen during the Great Recession. Distress potential. Increased interest rates put pressure on commercial real estate operators who finance with debt at historically high commercial property values, right? So the values of those buildings were at all-time highs when many of these financings took place. And so now the value of the assets have come down and financing costs have doubled. So it's a double whammy. Right? Your collateral has lost value and your debt for the new loan will be even more. Most of these loans mature in the next few years and may have to be refinanced at significantly higher rates, typically more than double relative to the original, resulting in increased risk of maturity default. The elevated remote, missing an R, the elevated remote working patterns relative to pre-pandemic levels may persist, eroding the demand for office space. By the close of 2022, the office vacancy rate had spiked to over 18%, reaching levels reminiscent of the Great Recession. This marks a significant escalation from the 13% at the end of 2019. By the end of November of last year, the equity value of real estate holding companies, REITs, specializing in office had fallen 55%. Whoo! The delinquency rate on commercial mortgages has been on the rise, surpassing 4.5% by November, with a notably swift increase in the delinquency rate on office loans, up from 1.5% December 2 years ago to 6% just 2 months ago. Delinquency rates on lodging and retail loans have also been elevated, standing at 5.2% and 6.5%. These trends underscore the increasing distress in the CRE loan segment. Almost done here. It's a couple more things. On average, a loan begins with an initial loan to value of approximately 61%, but by December, the LTV had risen to 66% because of a decline in property values. This increase is much more significant for office loans, which constitute about 1/5 of all the loans in our sample. Their LTV surged from 54% to 86%. So the assets fell a ton, so that the loan to value ratio got completely out of whack. They have a table below. That's where they mention these. Column 5 mentions this. Column 7 mentions this. Their table shows that the percentage of loans with a current loan to value exceeding 80%, which is a normal threshold for loan origination, shows that 56% of all office loans have an LTV around that threshold, meaning that more than half of office loans have a loan to value ratio where they wouldn't even be given a fucking loan under normal conditions. So like they're going to be facing significant friction to their ability to refinance their current liabilities, both because the value of the property has fallen. In some cases, the credit ratings of these institutions and entities has also not been good, has been downgraded, and financing costs have doubled. It's the worst of all worlds for this segment, the worst of all, and the core fundamental demand for office space has been disrupted by the pandemic. Like, can you think of a worse setup for these people? It doesn't exist. Column 6 shows the percentage of loans in a state of negative equity. As we observe, 14.3% of all loans and 44% of office loans are in negative equity. That's just fucking insane. Okay, last couple of parts. It's crucial to highlight the disparity between legacy rates and current rates on new loans. This is what I'm talking about. This is the increase in financing costs. For an average loan in our sample, the legacy rate, meaning the rate that currently exists for current loans, the legacy rate is 3.9%, whereas the rate for a new loan would be 6.7%. For office loans, the legacy rate is, again, 3.9%, and the current rate is 7.4%. This notable surge in interest rates results from an escalation in the 10-year and the monetary tightening of 2022, coupled with an increase in spreads. It underscores a formidable challenge faced by loans approaching maturity and in need of refinancing. 39%, so 2 out of every 5 loans and 1 out of every 3 office loans come to maturity in the next 2 years. Let's see, what's the last piece here? Oh, yeah. Wow. If loans today were refinanced at the current benchmark rate, 17% of them would be in negative income, not just negative equity, but they would be in a Ponzi situation where their income would not even suffice to pay their debt payments. 17% of all loans would be in that situation if they financed today. 1 out of every 4 office loans would have a DSCR below 1 if they refinanced at today's benchmark rate. 4.5%. So 1 out of every 20 loans has both negative income and negative equity. Like, completely fucked. They don't make enough money to pay their debts. They're upside down on the loan to value ratios, and they probably can't access new financing. CRE is absolutely toasted. They are fucked. And it's this chart right here. This is insane. And people think that the cycle is over. People think the cycle is over. They're literally white knuckling the last vestiges of zero interest rate policy are being held on to for dear fucking life, in the hopes that Papa Fed is going to swoop to the rescue soon and give massive cuts, huge cuts. Because if they're anything short of huge freaking cuts, it's not going to be enough. It's not going to be enough. And we just had the sharpest loosening of financial conditions that we've ever had, ever. By loosening of financial conditions from a market perspective, that means the falling of yields, right? The market's loosening up. Yields are coming down and financial conditions are becoming easier. The cost of new capital is becoming cheaper. We just had the fastest loosening of financial conditions in the history of the data. But the crazy thing about it is that the Fed hasn't changed their policy at all. It was completely a market-based loosening of financial conditions. It was entirely this. The 10-year getting sold off like a motherfucker. The 30. Mortgage rates. This is the loosening of financial conditions. The Fed has done nothing. All they did was signal that they probably aren't going to raise interest rates unless the data changes. That's all they did. And the market took it upon themselves to loosen financial conditions at the fastest rate in history. This is the return to normal trade. Global consensus. Here. The return to normal trade. Y'all remember this chart? The change in central bank rates in basis points, the expected change in interest rates. At the beginning of 2023, they expected these hikes. We actually got way more than that. And now everybody's expecting massive cuts, right? They expect massive cuts. They expect massive cuts. FedWatch tool, cut every meeting. More than a coin flip, a cut every meeting. Huge huge bid on the long end, which brought yields down hard for the fastest loosening of financial conditions in history. It's all the return to normal trade because everyone needs this to happen very badly. Very badly. JB Estrada says, where can I find this paper? Google NBER, commercial real estate. First thing. Right here. Monetary tightening, commercial real estate distress, and U.S. bank fragility. That's what it's called. December 2023. That's how you'll know it's the right one. I will put a link to this in the chat right now. That NBER link is this paper. Open it up, go down to download PDF, and click. The paper there's more math, and there's a lot more in here. I didn't read it all. They have tables and data backing up what they're saying. It's not just them saying stuff. But I read the highlights for you guys. Let me look through my tabs and make sure there's not anything else that I'm missing that I wanted to bring up. Bitcoin reached up and printed an all-time high with bear market technical and on-chain conditions in Q4 of 2021. Yet many folks who saw that now dismiss the idea that the NASDAQ or the S&P could do the exact same thing in their own way. And I think that's true. I think we might be seeing that. Where is it? Apple. Look at Apple. Look at that. Apple might have topped. We might have gotten the topping formation here on Apple. Microsoft is still going. NASDAQ's just barely reached the all-time high. The S&P's almost there. And we've got this overhang, this unresolved credit cycle. It's impossible to time the risks associated with something like this. So there's no reason to put a trade on because of something like this, unless you're a rates trader, in which case, why are you watching me? But I think if we're going to assess the risks over the next 12 months, this has to be at the forefront, right? This has to be at the forefront because of this right here, because of the global consensus trade, because of all of the news stories we've been looking at together about how rate cuts can't come soon enough for debt-strapped companies, or whatever the Bloomberg article was called. Find it. Yeah. Rate cut pivot can't come soon enough for debt-strapped companies. What are some of the other ones? There were some other really good ones. Private equity's new way to defer costs, and that's them taking out loans. Private equity funds are borrowing against themselves. Americans are finally turning frugal after splurging over the summer. That's not one of them, is it? No, there was a couple of these. We already looked through all these together. Wall Street wants to let junk firms pay interest with more debt. And we read a lot of these together. This is all happening now, right? This is not what happens at the beginning of a sustainable expansion for the economy. This is what happens at the tail end of a cycle, when people are still holding on and they're trying to manage the elbow turn into new conditions that are less favorable. And we're still going through that, right? And no matter how many of these stories you look at, what they tell you overall is that no one is currently operating at today's cost of money, right? They're doing everything they possibly can to kick the can a little bit further. And so it's really hard to see how the cycle here is supposed to be wrapping up. How the cycle's supposed to be starting anew when we haven't wrapped up the last one. And we're we're now 22 months into a Fed tightening. On average, they're 24 to 25 months long. And on average, recessions are not for another 8 months after that. Now, some things have happened faster, some things happen slower, but we're still like in the first half of the game. I said a few months ago that I thought we were in the fourth inning. Well, the fourth and fifth and sixth innings have been really long. So maybe the baseball analogy wasn't the best one, but we're still in the first half of cycle resolution, or we still got a bunch of people holding on to debts from the prior cycle. And the refinancing channel, which is typically a source of easing early in a cycle, is clogged up by these dynamics, by what we were just talking about with interest rates, by what I just read you on here. Current legacy loans are at 4%, whereas the rate today is 7.4. That's 350 fucking bips. You think the Fed's going to cut anywhere near enough to allow those costs to come back down? Not only the costs to come back down, but remember, the value of the collateral, the buildings that these people own, are also worth less. They're worth 40, 50, 80% less in some cases. You look at some of these real estate deals, these people are taking 75% haircuts to what they paid 2 years ago, especially in like San Francisco and stuff like that. So we're still working through this. And if the Fed is going to cut at all this year, even just a little bit, when we have so much raging animal spirits, I have a feeling they're gonna re-stimulate inflation and then be forced to react to that. And that could really hurt the bond market. That kind of a yo-yo could really hurt the bond market, because that's what we've seen in the past. It's what happened in the 70s when we got a reacceleration of inflation. That second wave is what absolutely decimated the bond market. So, really hope we don't have another one of those now, because I don't think that the world is ready to see a US 10-year trading at 5.5% or something like that when it hasn't been there in, 20 years. Yeah, 20 years. So that's kind of some of the stuff that's on my mind right now. Let me look in the chat and see what I've been missing. I need an H-E-B store, says JB Estrada. H-E-B is the best grocery store, by the way. I don't know how do I like my steak cooked? I'm a medium rare kind of guy. All right? I'm a medium rare guy. I missed any other activity? No, I think we're doing good. Do I believe higher interest rates will halt U.S. M2 growth? Well, isn't M2 already kind of slow? Yeah. M2's kind of stalled out here. I'll be honest with you. I really don't look at M2 that much. There's people who divide all their price charts by M2, and they think that Bitcoin over M2 and the S&P over M2 and all this stuff is like that's what they use that for analysis. I hardly ever look at this. I occasionally look at it. So I don't have a strong opinion about what I think is going to happen to M2. I have a stronger opinion about stuff like credit growth and things like that. I think it's in a real tough spot. This is some of the least healthy credit growth we've ever seen, and it's unlikely to reaccelerate in the current environment. You have banks actively trying to offload risk, and they're selling that risk to private equity and private credit. That's what we spent a lot of time talking about 2-3 weeks ago. And these banks are not going to lend just because the Fed cuts 50 basis points. This isn't going to reaccelerate all the way back up to 8-10% annualized where it normally is. We're in a really tricky spot there. And so anything at all that interrupts the flow of incomes to labor is going to have potentially an outsized effect on the rate of growth of the economy, because this channel has been closed up, and all that we really have going now is people's incomes and 7-8% deficits. Like, just for context for the deficit, I have a chart of the deficits. Let me find it for you. Deficits. Here it is. Yeah. I think I showed you guys this a long time ago. All these circles are 1 year, and it's the deficit versus the unemployment rate. So over here on the y-axis is unemployment. So as it goes up, we have higher unemployment. The bottom is the deficit. As it goes to the right, we're spending more than we're making. The deficit is getting deeper. We're in a surplus when we're over here. You can see the 2000 surplus right here. But the thing to take away from this is that the gray circles are just like regular years. These colored ones, orange, green, red, these are crises. The Great Financial Crisis in orange, we'll leave those alone. World War II in green, World War I in red. Those are periods of time when we've had low unemployment and extremely high deficits because we're literally at war and we've got to build a bunch of bombs and airplanes. These are the deficits today. They are the deepest deficits relative to unemployment being this low that we have ever seen. And this is a component of GDP. So it's kind of antithetical for people to make an argument that we have a booming economy right now when we are running the largest deficits outside of wartime that we have ever run in history. It's really hard for me to accept that this is a booming economy that is about to see multi-year expansion. It doesn't add up to me. And I think that if people are not demanding that the two candidates that surface out of the primaries for the presidential election later this year, it's probably going to be Biden and Trump again. If those two old fuckers are not constantly asked to talk about the deficit, then we are failing as voters. That should be the only thing we're talking about. How can you justify running an 8% deficit when we have record low unemployment? What is your plan to bring this down? So far, they have no plan to do that. So far, deficits are expected to continue growing if the Congressional Budget Office has anything to say about it, and they don't even factor in crises. They're just factoring in the legislation that's on the books, and they're expecting 8, 9, 10% deficits over the next few years. What's my optimistic view for the future? Well, I mean, I'm an optimistic person. It just depends on what we're talking about. I think we are not done dealing with negative outcomes for the current cycle. We embedded a bunch of excess into the markets and the economy in the build up to COVID, and then with what we did in response to COVID, it just made it worse. Everything from the GFC until 2020 was then exacerbated by the response to COVID itself. And we haven't paid for all of that yet. Paid for in quotes. And so I think that the market has some more churn to work through and negative outcomes over the next year and a half. I don't know, how long that takes, but I never doubt human ingenuity and human survivability. We're like cockroaches. We are impossible to kill, and necessity is the mother of invention. So I think that after GFC, the monetary authorities, they did everything in their power to dampen volatility, not just in the markets, but what that does is it dampens volatility socially and economically and politically and culturally. It tamps it down. And the way that we go about in engineering new change in society is through crisis. That's just the truth of it, right? It's through stress and through the efforts to artificially tamp down the natural volatility in markets in a capitalist system because we expect there to be so much fairness. We tamp those things down. We vote in policies that try to tamp down those things, and we encourage government spending that tamps down those things because, in the short term, it makes our lives feel a little bit better. It makes us feel like we dodged a bullet. But we can only carry that on for so long. And I think that because of the pandemic and the volatility it created, and then the excess reactions to that volatility, they've disrupted the apple cart. And so we cannot just continue tamping down volatility the way that we did from 2010 to 2019. We can't bring the surface of the water is too choppy, right? It's going to take a while for it to calm down. And so I think we're still going through that. And I think that it'll take the process of this decade, because that's what usually happens when we go through a period of intense change. It takes years. It's not something that happens in a single calendar year. It's not something that happens in 2 quarters, right? It's a multi-year process. Look at the 1930s and early 40s, right? That was a period of intense global change, and it took almost 2 decades to play out. So I that's what I'm mentally prepared for. It doesn't mean that it's an all negative thing. It just means that what we just left, I don't think is going to resemble what we're heading into. I think it's unlikely. The factors just aren't there, right? That we're cooking with different ingredients now. We can't expect to make the same meal. We're not even talking about AI, says Mac Hawk. Yeah, AI is the current new thing. If you think back to the internet was said to change the world. It did change the world. But did it change the world when the market first thought it would? No. The market got really far ahead of its skis. It started speculating on the potential that was far beyond what the technology could deliver in a reasonable time frame. And there was a correction. There was a major tech bubble and a big bursting of that bubble. But subsequently, the internet did change the world. It just took longer than people thought. AI will do the same thing, in my view. Everyone's really excited about it. They're dreaming about all the possibilities. So they've gotten out ahead of what it's actually ready to deliver right now in terms of a boost to productivity at a societal level. We still don't even know if whatever those productivity boosts are will prevent a bunch of people from losing their jobs and thus being a net drag on productivity. I don't know. Don't know. We'll see. Or that's not a net drag on productivity. That would be a net drag on output. I guess I misworded that. People could be more productive, but are we producing more in the aggregate? We don't know that that's true yet. Crypto Lolex says, how long and what about crypto in a different environment? The heart icon, how long and what about crypto? I don't know how long the bear market might last. We just had a bull year. What I could call this a bear market, but I would be wrong in the sense that 2023 was straight up and some things made all-time highs. The NASDAQ made an all-time high. The Dow Jones made an all-time high. So calling it a bear market is not accurate, but it is the end of a cycle. I think we are in the topping phase of a grand cycle, and that it will take a few years to top, first of all, just look at the chart. It just looks ridiculous, but this has been a 3-year process, right? This is late 2021 over here, 2.5-year process. And it's still not done yet, right? So me saying it's a multi-year process isn't that much of a surprise. Just think back to when we first got into this range here. How long has this been? 1,200 days. That's since, back here. Let me move this up. Move this up to right here. Yeah, January 2021, 1,000 days. Basically, all of 2021, all of 2022, all of 2023 has just been on the market. Just that. And I'm just proposing that we might do more of that, because of everything we've been talking about. And that's not that crazy of a thing to say. But even inside of here, I'm just doodling, by the way. This isn't a price prediction. But even inside of here, there'd be huge rallies, and this could be totally wrong. But we clearly are not done resolving prior issues, as we have explored at length. And when you think about people's expectations, what manifests in price is the delta between expectations and reality. That's how we end up with price action doing what it does. Right now, people's expectations are extremely high. Their expectations for the S&P are very high. For the economy are very high. Their expectation for Fed cuts are very high. Their expectations for Bitcoin are extremely high. And so if any of those things fall short of meeting expectations, or if there is new information that arrives to the market that disrupts their thinking about those expectations, that introduces more opportunity for volatility. And the higher those expectations and the more people subscribe to them, the more potential energy there is for a repricing. Because all this is just a bunch of people's opinions about something, all condensed down to a number at a point in time. And people get shit wrong all the time. All the fucking time. People got the ETF wrong, right? We spent the first 20 minutes talking about. Everybody was wrong about yesterday. Were they wrong about today? Today was no better. Here's volume for all the ETFs. Here, look at the candles. Look at them. Significantly lower volume on day 2. This just isn't playing out the way people thought. Their expectations are having to be reset. Some of that got flushed 2 days ago when we got the fake approval and a bunch of leverage in both directions got rinsed. That was expectations having to be reset. Alvaro, do you think this might be the halving that breaks the 4-year cycle? Well, I'm not a big subscriber to the 4-year cycle, but there have been some symmetries so far. And what I've proposed for people to think about is that Bitcoin's been in these cycles, right? Let me having Bitcoin having events. We'll put them on here. Yeah. Let me do BTC USD index. Yeah, let's do that one. Oh my gosh. So we've had these cycles for Bitcoin and they've been pretty consistent. They have not been 4 years. They've been different amounts of time. They're around 4 years. A couple in the middle, I think we're kind of close. This one's longer than that one. This one was only like 2.5 years. The first epoch was only like 2.5 years. But the meat of your question, do I think that the symmetry of the prior years will break? Yes. Do I think it's because of the halving? No. Do I think people pay too much attention to the halving? Definitely. And what I suggest, and this is just my way of thinking about it, is that, Bitcoin has had these cycles like this, and now it's going up for another one. But during this whole period here, there's been one continuous economic cycle that I think might be starting to turn. And that long continuous cycle was supportive of these smaller ones. It was also supportive of risk broadly, right? Equities did the same thing. We had a bunch of altcoins go from zero to many billions of dollars of valuations during the same time. It wasn't just Bitcoin. A lot of things gone up in this period. There have been oscillations in the business cycle, peaks and troughs in PMIs, peaks and troughs in yields within these cycles. But the economic expansion has been pretty much continuous. And now it looks like maybe we're turning this way. And so if we are, I just want people to question if it's possible for Bitcoin to just do that. Or is it more likely that it follows? Because it has been under the umbrella of the larger macro cycle the whole time. People don't want to believe that because they think Bitcoin is imbued with magical properties because it has a finite supply and no one controls it. But it is a market. Its price is determined by a bunch of humans clicking buttons, the same way everything else is. So it isn't magical in that way. And the underlying conditions, I guess I should have drawn this underneath because it's really been supportive of price. The underlying conditions have done one thing. And if they're going to fall out and be unsupportive for a period of time, even if the Fed tries to respond, it doesn't mean they can stop bad things from happening. And if they push it too far, they will definitely not be able to slow it down. But if we're just going to have a turn down in that cycle, if it seems like that's possible, then I have to believe it's very likely that Bitcoin's cycles inside of here will not look the same anymore, right? That maybe it's printing a 15-year fractal that we haven't seen the end of. And then it's going to start another one. And then another one that has a bunch of these inside of it. And then, 15, 20 years from now, fucking does this again from a higher place. I don't know. I would just suggest to people that what we have seen so far is not the only thing we will continue to see in perpetuity. There's plenty of reasons to think that's not true. JB says, how do I plan to educate my kids when it comes to understanding the markets? Well, I don't really know if I have a plan for that, JB. I'm just going to be honest with them. That's how I am. I'm a no bullshit person. I don't lie to my kid. I don't hide things from him. When bad stuff happens, I explain it to him. When someone passes away, I explain it. When he can't have the toy, I explain it. I don't shy away from honesty with my kid, because I think my kid is more mature than someone else might give him credit for. And I think a lot of people's kids are a lot more mature than they give them credit for. So, you know, he sees me on the charts every day. He listens to me doing these live streams. He knows that it's a part of me and it's part of my interests. And, you know, he's only 10. So, you know, the lessons we learn now are very simple ones. Saving money, you know, how debt is not the same thing as savings. Basic stuff. How you have to make money to spend money. When you write a check, you have to have the money in the bank. You can't just write a number on paper. You know, all that kind of stuff. Those are the things we're talking about now. Alvaro says M2 continues going up. BTC continues going up. Bitcoin is global, and global M2 is going up forever. You like, listen, I get it. But that's just far too simplistic of a model for me to use in some kind of a way. You know, I don't really know where to take that. What about yield curve and recession? Do I have a timeline? Pray Joe, I believe, my friend, that you might be new to the channel. We have definitely covered timelines. I think something that you might find interesting. First of all, I would suggest going to the channel and watching the recession roundup playlist if you didn't yet. Go to playlists, and there's 4 videos in here that talk about our framework for looking at recessions. The 4th one's more about Bitcoin. The first 3 kind of lay the groundwork for a lot of the charts and things that we use in here. Not all of them, but a lot of them. I would say watch those, and then actually the video right after that. Is it running below trend? I believe this is the one. Should probably check this one out too. Let's see. Yes, running below trend. So I would suggest watching that playlist if you haven't. If you haven't, throw it on over the weekend, listen to it, and then watch the video running below trend, because it comes right after that. And that's when I introduced a couple of the newer charts that we ended up using quite a bit more, like this one. And they will give you a general timeline. There's nothing hardcore about it. There's no science. Economics is not a science, but it's a framework for how to think about this process. Right now, we are in the hot zone of the tail end of what I would call the sweet spot of when recessions normally happen. We still have a few examples of them out in front of us based on when the yield curve inverted. And that, even in and of itself, is not an ironclad rule. So even if we saw this line get to the 18 right here and it didn't feel like there was a recession, that wouldn't necessarily mean, oh, the coast is clear and we're fine. We'll need to be more nuanced about it than that. However, based on history, we've got another 4 or 5 months of data, including January, to collect through the second quarter before we can start to say, wow, this really doesn't look like any historical comps that we've ever seen. Right now, it still kind of looks like it. What do I tell my child about Santa? I did lie to my kid about Santa. Totally lied to my kid about Santa. I think this might be the last Christmas that we get a chance to do the Santa thing, because he's around that age where someone at school is just going to ruin it for him, you know? So, yeah. So, I think that's about it today, guys. If you haven't hit the like button, please go ahead and smash that like button. It's the easiest way for you to support the channel. Yeah. If there's any last questions, make sure you get them in the chat. We did a members stream last week. We'll do another one another couple weeks from now. I will decide the week we do the member streams the week before. So I'll tell you a week in advance so that you can make sure if you want to be around for it, because we're going to do it, 30, 45 minutes after the public stream, whenever we do the next one. I'll make sure I tell you a week in advance. So if you want to come to that, you'll know it's the next one. And I won't surprise you. This last one, I think I surprised some of you guys and maybe you weren't able to make it. So we'll do better about that. It's part of the learning process of doing this shit live. Is my kid listening to this stream? Thankfully, no. Thankfully, he is at school today. Jasper says, I want to say I appreciate your content. Very solid. Thank you, Jasper. I'm not clever enough to make this shit up, so we just look at the data and we talk about it in a rational way. No surprises, no special sauce. It's all transparent. It's all right in front of you. And if we don't know, we don't know. And we say we don't know. And that's okay. Right now, we don't know. I will say, I think it's possible we're near the top on Bitcoin. I think it's very possible. Good buddy of mine thinks it probably is the top. That certainly influences my thinking of its likelihood because he has a track record of nailing that shit. And for what it's worth, we just butterfly kissed the low point of the box that we have drawn on here for 2 years, 3 years, since the beginning of 2021 when we first talked about this. But it's not advice. That's just based on my feelings and the way that I'm looking at things. Certainly, come to your own conclusions about your bags. I have a portion of my Bitcoin I'm not selling no matter what. But I have taken some profit here because it was the prudent thing to do. And after buying in this general area here, I didn't buy on the absolute Pico low, but I did get something with some 15s on it. After buying down here, it was just the right thing to do, I was up 202. I was up 2 times on the trade, so makes sense to take some profit on ETF. Around the launch of the ETF, I did it late last night after I'd seen everything that had happened. We'll see. We'll see what happens here. We'll see how this plays out. Last look at the ETFs. God, they just look like shit. Daily volumes. This is daily dollar volume. So if you notice, each one of these columns is about half of what it was the day before on most of these. Not great. iBit, that's the BlackRock. 400 million of volume after $1 billion day yesterday. So that's it. Really appreciate all of the support in the channel. It's so amazing to see so many green names in there. I had never asked any of you guys to do it, and I actually only mentioned it one time, and it's just absolutely taken off. It's so amazing to see that. I'm very grateful. My heart is full. Thank you. We'll just keep crushing it. So I hope you have a great weekend. Hope you enjoy yourselves. We'll do the next live stream next Thursday or Friday. I'll schedule it a day early, as we usually do. And that's where we will leave it, friends. So until the next time, take care of yourselves. Take care of each other. Give your friends a call over the weekend. Talk to your mom. And pay attention to that Bitcoin chart. Kind of looking like ass. Let's hope that I'm completely wrong and that we've got at least one more eye-bleeding ripper left in this market before BTC goes a bit lower. So that's it. Thank you. Love you. Tip your waitresses. Don't forget to have your pets spayed or neutered. Help control the pet population. Take care, everybody. Cheers.